I continue to see a lot of investors expecting better things from Rivian in 2024 as the company expects to reach gross profit by the end of this year. But what I think we're mistaking here is the impact that gross profit is actually going to have on the bottom line. Rivian's still going to be losing about $4 billion per year, going to be burning through billions of dollars worth of cash that they don't have in the balance sheet. And there's a fundamental problem with the business model the Rivian isn't going to be able to overcome just by getting to gross profit positive. And that's that they're building a vertically integrated business model. A lot of the software, the hardware that they're doing is vertically integrated. And that means that they should be able to theoretically build a better product than competitors. But there's a couple of problems with that. One, you need to have a higher price point. And two, you need to have more volume than Rivian has. So this is the fundamental problem that Rivian faces. I want to go through in detail why I think a lot of investors are overestimating Rivian's potential today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with the profit number, because this is what a lot of investors are talking about is Rivian's expecting to be gross profit positive by the end of the year. I'm going to go to the direct quote. This is from Claire McDonough, CFO, on the first quarter 2024 earnings conference call. We continue to move closer to making money on every vehicle we sell. We expect to see meaningful improvement in gross profit during the second half of this year, and we believe we will reach gross profit positive in the fourth quarter. So what exactly does that mean? That means that for each vehicle that they're selling, they're going to theoretically make a profit on the components involved in building that vehicle. So when you cover your manufacturing costs, your raw materials costs, all the costs that go into actually producing the vehicle, they're going to be profitable. That does not cover operating expenses like sales showrooms, like research and development, like design that's going into the R2, any of those kind of things. So let's look at a chart at what the company's profitability looks like right now. This is trailing 12-month numbers. So that's why revenue continues to go up, even though it's a little bit choppy. Same thing with gross profit. But you can see that Rivian has been losing money on every single vehicle that they've sold, almost $5 billion in revenue over the past 12 months, $2 billion in gross losses. So what management is saying is that those gross losses are going to go to zero in the fourth quarter. There's a couple of ways that manufacturing companies can do this. One is by increasing their production. That spreads fixed costs over more units, or they can reduce their costs per unit. So Rivian is doing both of those things by the end of 2024. What they are not doing is saying that they're going to generate an operating profit. And that's where operating costs become really important, because the operating numbers are enormous for Rivian. This chart shows Rivian's operating expenses. So SG&A is in yellow, selling, general, and administrative expenses. R&D expenses are in blue. This is going to be everything from operating their showrooms to paying executives to paying engineers. All of those costs are going to go into operating expenses. And you can see that these have been pretty steady from the start of 2022 through today. So I wouldn't expect massive cuts in operating expenses in the future. So let's take $3.7 billion as the run rate for operating expenses. Why is that number important? That's important because to get to profitability and positive free cash flow, Rivian needs to be able to cover this $3.7 billion in operating expenses with gross profit. It's gross profit minus operating expenses that equals operating profit. So if they're not able to cover this $3.7 billion number with that gross profit, they're going to still be losing money. And this is fundamentally where I think Rivian is going to be, is they're just not going to be able to get to profitability, because at the $3.7 billion number, they have 215,000 units of capacity in Normal, Illinois. Now, they don't have enough money to build the Georgia facility, which was going to be another 400,000 or so units of capacity. That was going to spread their fixed costs across more revenue and more vehicles sold. So right now, R1, RDV, R2, all going to be produced in Normal, Illinois, 215,000 units of capacity. That means that Rivian is going to have to make a gross profit of $17,210 per vehicle. That is an incredibly high number. As electric vehicle prices are coming down, you're starting to see vehicles be available for under $30,000. Sure, some are $50,000, $60,000, $70,000. But even at that price point, even at an $80,000 price point, Rivian would have to generate a 21.5% gross margin. No automaker in the electric vehicle space is doing that. Tesla isn't even doing that, and they have reached scale. So this is the fundamental problem. And why is this a fundamental problem for Rivian? It's because of their business model. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is a little bit small, but I want to go through this line from Rivian's SEC filings from their most recent quarterly filing, because I think this is really important. The vertical integration that is involved in Rivian's vehicles is actually fundamental to the company and the products that they're producing. Starting with a clean sheet, we built a vertically integrated ecosystem comprised of our vehicle technology platform, cloud architecture, product development and operations, products and services. Interconnected by our data and analytics backbone, our ecosystem is designed to deliver fast-paced innovation cycles, structural cost advantage, and exceptional customer experiences. They go on to say that they are expecting to further vertical integration in manufacturing. So vertical integration is key to Rivian, but this is also a huge problem when it comes to making money. The key to vertical integration working is having enough volume to actually have it make sense, because you're spending all of these operating costs up front to develop products, to do the software, to build the hardware, to design your own batteries, design your own motors, do all of this stuff that Rivian is doing on their own. But there's not a lot of efficiency if you don't have a bunch of volume going through the system. Go to just like a major extreme. Let's say that Rivian was building 10 vehicles per year. They were spending $4 billion on operating expenses to design and develop that vehicle. That would be an incredibly expensive vehicle to just produce 10 vehicles per year. If they're producing 1 million vehicles per year, now that same cost is going to be spread across 1 million vehicles. You don't need to be nearly as profitable per vehicle. So there's a benefit to scale with vertical integration. The perfect example of this right now is Apple. Apple is insanely profitable because they have the scale and vertical integration working for them. They can design their own chips because they're selling hundreds of millions of devices at a time. They can have storefronts because they're selling more per square foot of store than any other company in the world. So that vertical integration works to Apple's advantage. It makes their products better, it makes their products more valuable, and they're getting the economic benefit from scale. Rivian, on the other hand, is taking on all the costs associated with vertical integration, but doesn't have any of the benefit. They're only going to have 215,000 units of capacity. By comparison, Tesla is going to produce somewhere around 2 million vehicles, so about 10 times as many vehicles as Rivian is going to be able to produce with its current facility. General Motors, going to do the same thing, going to sell a few million vehicles. So the software changes that they're making are going to be able to be spread across hundreds of thousands, if not millions of vehicles as those vehicles are launched. Companies always have a choice. You can vertically integrate, you can basically do something yourself, or you can choose to make suppliers modular. Say, you know what, we're not going to design our own motors. We're going to actually outsource that to somebody else. Just buy that product off the shelf. That's going to lower your costs. Yes, you're not going to be as differentiated, but in a market like electric vehicles, it would make you more cost effective. And this is fundamentally the problem that I think Rivian has gotten itself into. Yes, it's making a great product. Yes, the updates that they made to the R1 line of vehicles look really compelling. But at the end of the day, if you can't get to scale, then none of this matters. This chart shows Rivian's cash position and the company's free cash flow all on a trailing 12-month basis. You can see that as it currently stands today, Rivian only has about a year's worth of cash left. Now, they're going to be reducing that free cash flow number because they're not going to be spending quite as much on capital expenditures. Hopefully they are going to get to gross margin positive, but they are still going to be burning somewhere around $4 billion just from those operating expenses that I talked about earlier. So getting to positive gross profit is not good enough for Rivian. They need to get to positive operating profit. And that is going to be much, much harder because of the business model that Rivian has built. That vertically integrated business model relies on having either a very premium price point that's going to make you extremely profitable on a gross margin basis, or getting to a point where you have scale. Ideally, you have both of those things, but Rivian has neither of them right now. And that's fundamentally the problem with the company and the stock getting to a sustainable point. What do you think about Rivian? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.